Hi and Assalamualaikum. My name is Iflatul Azira binti Nazri and I'm from JPA 2512F, students of FIN430 Cawangan Johor, Campus Gamat. To prepare ourselves for the future world of employment related to the field of management and business, finance and investment, among the things we need to know that is corporate finance. The three main areas of corporate finance is capital budgeting, capital structure, and the last one is working capital management. So today, in the subject of corporate finance, I would like to explain about CAPM, SML, and WCM. An individual who are expert in corporate finance will be so familiar with these three acronyms, which is three subtopics to apply in their career. Okay. First of all is CAPM, or some of us call this as CAPM. CAPM is stand for Capital Asset Pricing Model, a model that describes the relationship between the expected return for asset, particularly stock, and the risk of investing in a security. So now we look at to the CAPM formula. RA is referred to the expected return, RRF is referred to the risk-free rate, and BA is referred to the beta, and RM is referred to the market risk premium. Next, let me teach you how to calculate expected return on a stock using the Capital Asset Pricing Model, CAPM Formula. Suppose the following information about the stock is known. The 10-year treasury is referred to the risk-free rate, which is 2.5%. The annual return stocks is referred to the market return premium, which is 7.5%, and the beta for the stock is referred to the beta, which is 1.25. And the answer will be 11.9%. Why CAPM is important? The CAPM formula is widely used in financial industry. It is vital in calculating the weighted average cost of capital, as CAPM computes the equity. WACC is used extensively in financial modeling. It can be used to find the net present value (NPV) of the future cash flows of an investment and to further calculate its enterprise level and finally its equity value. So for example, I can give is there is two types of stock, which is stock A and stock B. I bought stock A for 0.7 beta and stock B for 1.7 beta. If the price of stock A go down for $1, I will get loss 0.7 times from that $1. And if I can make profit from stock B, I will get more profit of 1.7 times. But if the company lost, I will get 1.7 times more losses. So basically, the optimum beta is 1. So the conclusion for CAPM is the more volatile a market or an asset class is, the higher the market risk premium will be. Now move on to the SML. SML means Security Market Line. It is a visual representation of the Capital Asset Pricing Model. SML is theoretical representation of the expected return of asset based on systematic non-diversifiable risk. As you can see, this is the SML formula and the graph showing that purple line, which is the SML. The SML can also determine whether an asset is overpriced or underpriced. If the asset gives a return higher than the markets for a given level of systematic risk, it will be plotted above the SML. And if the asset gives a return lower than the markets for a given level of systematic risk, it will be plotted below the SML. The intuitive reason why an asset that is plotted above the SML is underpriced is that it's giving a return larger than the market. It is because the cost of buying the asset is not large enough. The return of an asset is directly related to the price at which the asset is bought. Thus, with the SML, if an asset is providing too large at a return, it means that it's underpriced. The same intuition holds for when an asset is overpriced. The price of the asset is too high, which eats away at the returns the asset provides, and thus causes the asset to be plotted below the security market line. With the efficient market theory, assets that are plotted above the SML are bought, which increases the demand and the price of the asset, thus decreasing its expected return and bringing it back down to the security market line.
And last but not least is WCM, which is Working Capital Management.
Working capital management is a set of activities performed by a company to make sure it got enough resources for day-to-day operating expenses, while keeping resources invested in a productive way. WCM has two main decisions at two consecutive stages. They are as follows. First, the level of current asset, how much to invest in current asset to achieve the targeted revenue. Second, the means of financing current asset. That means how should the above current asset investment to be financed, the mix of long and short-term finance. Working capital management policy deals with the first decisions, and working capital management strategies or approach deal with the second decision. There are three policies. First, restricted policy. Current asset estimation is done very aggressively, implemented without any tolerance of deviation, saves interest cost due to lower working capital requirement. Second, relaxed policy. It is the current asset estimation is done after careful consideration of various factors, advantage of no or low risk. Third, moderate policy. Balance between the other two policies. Risk is lower than the restricted and higher than conservative. Reasonable assurance of smooth operations. So that we have three approaches refer to the policies. First is aggressive approach. Aggressive working capital financing policy is a risky policy that requires maximum amount of investment in current asset. Fluctuating as well as permanent current asset under this policy will be financed through short-term debt. In this policy, debt is collected on time and payments to the creditors are made as late as possible. Next is conservative approach. As the name suggests, this policy tries to avoid the risk involved in financing of current asset. Here, relatively high proportions of long-term sources are to be used for financing current asset. The firm not only match the current asset with current liabilities, but also keep some excess amount to meet any uncertainty. This is the lowest risk working capital policy and fails to ensure optimum utilization of funds. Hence, it cut down the expected returns of the shareholders. The last one approach is hedging approach. One of the policies by which a firm finances its working capital needs is the hedging policy, also known as matching policy. This policy works in an arrangement where the current assets of the business are used perfectly to match the current liabilities. As per this approach, fixed and permanent current assets are financed through long-term sources and fluctuating current assets are financed through short-term sources. This policy is a medium risk proposition and requires a good amount of attention. For example, if a bank loan is due to be paid after 6 months, the company will ensure that sufficient amount of cash will be available to repay the loan on the date of maturity, even though it may or may not currently have sufficient cash. So all explanation has done. I hope my explanation related to the CAPM, SLM and WCM will help you a little in understanding the world of corporate finance. So good luck and all the best. Bye and Assalamualaikum.